What are some sectors kind of maybe thinking about with the results or the fallout from the election?
It's played out very similar to the way it played out back in 2016. A lot of the same sectors doing well right out of the box. Financials were one of the top performers. We saw energy do pretty well. Industrials did well. Even more importantly were the areas that did not do well. Healthcare, again, utilities didn't fare particularly well. A lot of people would think that real estate would be a beneficiary. It has not been. It was not in 2016. Very, very similar in terms of short-term performance. We'll be able to sort through them as we move forward.
Welcome to another edition of Wealth Strategies Unleashed. I'm Robert Gilliland, and
I'm Mike Alexander.
Hey, Mike, thanks for coming in today.
Hey, it's great to be here.
It's always good here. Just so everyone knows, Mike Alexander is the Chief Investment Officer with us here. Before we get started, I'm going to go ahead and apologize. It has been a rough week. It was so rough this morning. Obviously, I didn't get enough rest. When I finished working out, I went to go put my ear pods back into the case. And I always chew gum when I do it. And instead of putting my ear pods, I took my gum out and put it into my case. So it's one of those mornings. Needless to say, I have an issue with my ear pods now.
Well, hopefully you found the gum, though.
Yeah, I did. I knew where it was. So good thing I didn't put the gum in my ear. But hey, Mike, we recently had an election. We had a winner.
We did.
And I was thinking what we would do today is let's talk about what does the election mean as we go and we look forward. And we'll kind of start this way and we can kind of dig into these. When you're talking about sectors with the election and knowing that it's not going to all of a sudden happen overnight, but the market's always move in advance. What are some sectors we need to be kind of maybe thinking about with regard to the results or the fallout, if you will, from the election? Yeah,
so First of all, you're asking a great question, and I would say that heading into the election this year, people are posing the same question. It's okay, who's going to win, and if they win, what does that mean? What does it mean for markets? What does it mean for various sectors of the marketplace? The interesting thing is that with Trump winning the White House and winning Congress as well, it's played out very similar to the way it played out back in 2016, and you would think. Look, 8 years. There's 8 years between the first time he won the White House and where we are today, and somehow miraculously, a lot of the same sectors are doing well right out of the box. Now, it's not exactly the same. I will say that this time we had a situation where he was tied with Elon Musk, and so. One of the areas that did really, really well was the consumer discretionary area, which did not do well back in 2016, the first time he won. But obviously, Tesla makes up a big part of that.
So just names, obviously you just did Tesla, but what are some other companies that are consumer discretionary companies?
So Amazon would be another one. So those are perhaps two of the biggest members of that index, if you will. And so there's been a little bit of a difference, but the tried and true ones from the last time, financials were one of the top performers. We saw energy do pretty well. Industrials did well. And I think maybe even more importantly were the areas that did not do well. And so this time they happened to be healthcare again. Utilities didn't fare particularly well. And a lot of people would think, with President Trump being involved in the real estate business, that real estate would be a beneficiary. It has not been. It was not in 2016 either. So very, very similar in terms of at least the short-term performance, maybe a week out from the election. Now, I think those things tend to level out over a period of time, and we'll be able to sort through them as we move forward.
You mentioned a couple that we think are going to be great, right? What about those that are going to experience some headwinds? And you kind of mentioned those, like you said, that real estate. We're clearly in a different interest rate environment right here, right now. We clearly have a housing shortage. Real estate is a lot of different things, right? It can be multifamily, it can be commercial, it can be residential. There's a lot of different things inside there. But the one thing that's going to end up. So talk a little bit about those that we can expect to experience kind of some headwinds that not that they're not good to be invested in, but we just need to be aware.
Yeah. So again, great question. I think a lot of folks are kind of looking around, kind of sorting through various policies and policy decisions, and they've looked very closely at every cabinet member that's named, and the result of that is that you have a situation where interest rates actually were rising ahead of the election. They've continued to rise post the election, and that's because the expectation is that you're talking about more deficit spending
right.
As we move forward. And by the way, that was the case with either one of the candidates. So it wasn't specific to one candidate, but clearly there's a little bit more of a focus because one of the president-elect's major policy decisions or policy initiatives is to cut taxes again, and particularly for domestic manufacturers. So the second part of that is to make the previous Trump tax cuts, make those permanent moving forward. And so the interesting thing when you talk about tax cuts is that tax cuts from a government perspective actually equals a cost, right? It means loss of revenue equals a cost. So the types of sectors that you would imagine would be under pressure are those that are tied to interest rates. So imagine again, real estate and utilities happen to be very interest rate sensitive. I will also say this time because we mentioned Elon Musk being associated with the new administration. We also have RFK Jr. being associated with the administration as well. And while there's obviously Make America Great Again or Let's Fix America, but there's also Make America Healthy Again.
Right,
and
right.
so there's been additional pressure on the healthcare industry. So pharmaceutical companies have been relatively weak post-election, and the other area has been consumer staples. Again, we're talking about perhaps reworking the FDA and some other administrative functions.
Just so everyone's clear, consumer staples would be companies like Kraft.
Yeah,
Heinz.
Procter and Gamble,
Gotcha.
Pepsi, Coke, McDonald's. Some of these companies that are perhaps associated with maybe more with fast food, but also off the shelf items.
What about regulations? What industries? Because it's very clear that if it still remains to be seen exactly what Elon Musk is going to is. It's not going to be something is it going to be an advisory role? Is this going to be some sort of commission? What is he really going to be an employee of the federal government? It's not going to need Senate approval. Is there really going to be this department, right? That remains to be seen. But one of the things inside there is going to be about taking care of regulation and where the costs are. What sectors stand to benefit from any changes in regulation, and what sectors stand to do better?
Yeah. So first and foremost, as we saw back in 2016, the first time Trump was elected, the number one beneficiary was the financial industry, and so coming out of the box this time, I mentioned that some of the consumer discretionary names were tops 1 week out, but the number two area has really been the financial area, and so. It's interesting, Robert. I was reading an article, and I want to say this was in Fortune magazine, but they were talking about the difference in terms of the regulatory environment between the previous administration and the incoming administration. And so, the previous administration, the Biden administration, had levied somewhere in the neighborhood of $1.8 trillion in additional regulatory costs. Trump, during his first term, that number was about $65 billion in regulatory costs. So if you're thinking about the incoming administration, the easiest place to actually make some cuts, if you will, is in that regulatory space, and clearly financials have taken off as a result of that. So think of them as being, perhaps number one. There's perhaps other areas like energy, which actually performed quite well coming out of the gate the first time that Trump was elected. It has not done as well this time. But again, I think you have to think about we're in a different geopolitical environment. The global economy is in a little bit different place than it was then. And so I do expect some back and forth in those areas. But think financials, first and foremost.
So that's interesting. You mentioned energy because over the entire 4-year period, green energy did better than oil. During the Biden administration, oil has done better than green energy. Now, if you stop for a second, which to me at first that was a head scratcher, then it all made sense. It all made sense because the price of oil came down significantly and we were able to buy gas for a couple nickels as opposed to a couple $100, right? It was a lot more that prices really went up. A lot of that has to do with drill, baby drill. A lot of that has to do with the regulatory environment. Is that same type of thing going to play out? Because if energy prices come down, energy companies' revenues are going to, what drops down to the bottom line is because they're making less money.
Right.
Their margins are going to shrink.
Yeah, I think there's some expectation of that. Now, it may not necessarily be related to exactly what's happening in the U.S. market. I think you have to think that we're in an environment where global growth is relatively benign or relatively weak. China's been weak. Many parts of Europe have been weak, and so we're in this kind of arena where the U.S. is really the place to be. That wasn't necessarily the case the first time around, and really not for the entire Biden administration. Just to remember, also, I know it seems like it's a long time in the rearview mirror, but we also had COVID in there as well, and so I think this time is a little bit different. Now, that doesn't mean that investors aren't playing it the same way, at least in the early stages. And like many of these situations, when you have a stealth move in markets, then you have to kind of take a pause and sort through it. But I think a big part of what you saw right after the election is just an abrupt repositioning of assets to be ready for it. One thing we may be getting to, but this kind of ties into some of the various sector areas, is that if there's any caveat to anything that we're talking about as it relates to markets, it's that interest rates have been rising, and there is a point where the equity market, because valuations are certainly not cheap,
right,
that valuations can begin to be a problem if interest rates are to rise too significantly from where they are. Now, we know from the previous administration that interest rates fell during that period of time, but it's just something that we want to keep in mind because it can turn from what was a tailwind and can turn into a headwind fairly quickly.
Yeah, it's interesting you say that because at a time that we've had in the recent past, we've had interest rates, the Federal Reserve cutting interest rates have gone the opposite direction. So that's telling us that the bond market is seeing something that they're seeing issues that's different than what the Federal Reserve is seeing, right?
Absolutely.
And the Federal Reserve clearly is seeing weakness in the economy, or at least not super strong growth. And recent numbers have proved that to be, whether it's employment or CPI or whatever, right? Or GDP. But it is really interesting to me that they cut and interest rates are going up. It's just kind of, I don't know if you have any sort of take on that, other than that just kind of helps out to create more volatility. And
it certainly creates more volatility, in particular in the bond market, where we actually have seen quite a bit of volatility. As a matter of fact, it's not uncommon on a daily basis where you're actually seeing bonds moving more than stocks are moving, and so that has not been uncommon of late. I think a lot of it has to do with the fact that markets are perceiving a more, let's say, pro-growth administration coming into office than the one that was here previously, and so the bond market has kind of reflected that, or at least is speculating on that, and that there is a sense that if you're the first thing that Trump is likely to spend time on is actually tax cuts, because those you can get done, extending the previous Trump tax cut is easier to do. I think things that can create headwinds like tariffs may not come until a little bit later. It's not that people aren't thinking about those things, but right now they're kind of keenly focused on this balance between, a strong labor market and inflation is still there, and the rate of change is coming down and is kind of in line, but it's still operating in the background. So obviously, if you're cutting rates, maybe stimulating the economy a little bit there, you're stimulating the economy in terms of tax cuts. Is there a possibility that inflation restarts? And obviously, if there's anything that creates a headwind for the stock market, it's
well, it's
higher
interesting
inflation.
about that. Which in going through, if you go through to look at some of these different things that kind of are indications of recession, one of the things that we've spent a lot of time talking about and sharing with our clients, and I've talked about it on several podcasts, is that when the yield curve goes from inverted back to normal since 1971, every single time you were in a recession 4 months later.
Right.
Well, that's what happened in September. So you can kind of do the math. And one thing I know is when you go to think that, well, this time it's different, it's really not different. Right. And then you look at the possibility of the longshoremen going on strike at the beginning of the year, creating a supply chain issue, which then creates more inflation, and all of that kind of coupled together, and we end up in a recession. Right. My take is that what Trump is going to want to do is that my guess is that he's got people a heck of a lot smarter than me. Maybe not you, but a heck of a lot smarter than me.
I'm for sure. It is for sure he does.
And
than me.
They have to be able to see this also. Yeah. And therefore, they're going to want those first 100 days before it actually starts to hurt to have a tremendous amount of successes. Because as we know, the stock market, which is what he used as his barometer for his success, Biden also used that at times as his barometer for success. He's going to want to be able to point to that to say we're on the right track, we're moving through and correcting this.
Yeah, you're 100% right on that. I mean, I think we know from the first Trump administration that he pays attention to the market. As a matter of fact, he had the second best first year of a presidential term ever, and that's just measuring it by the Dow Jones Industrial Average, which is up, I want to say, 32% during his first year. And
that seems like forever ago.
it does seem like it was forever ago, and so we're also as we go into 2025, we're also coming off of two really strong years in the equity market as well. So I think there'll be a lot of attention to that. I think one thing, and I think this is important, I think, for investors to keep in mind is that global growth is, again, we touched on it earlier, but global growth has actually been really, really slow, and it's been that way for a while. Companies overseas have not really been growing their earnings a great deal. The U.S. has really been the only game in town, and as part of an America First agenda, you could clearly see a continuation of that, and maybe even more so than what we've seen in the past. That doesn't mean people don't want to diversify. It just means you might have to be patient with some of these areas and wait for them to come around.
Right. So to kind of wrap this up, and because you and I talk all the time, I know this, so this is definitely going to be a leading question. There's a real possibility of volatility as we kind of look forward into 2025. If you take that piece that the points that I made, and you take them as in the realm of possibility, there's a possibility of a recession. You could have some volatility. You could have a strike. You could have a couple other things that go on. We have two wars. We've got a lot of things. There's going to be some volatility we see coming down. We just have gone through 2 years where it's the same companies leading everything. That's the Magnificent Seven.
Right.
As we look into 2025, what kind of strategies and key sectors should we be looking at to make sure that we're managing that volatility as we kind of go forward?
Right. So I think we will see volatility. I don't know if it will be as pronounced as it was during the first Trump administration. And I'll cite a couple of reasons why that might be the case. I think a lot of lessons could be learned from that period of time. You might recall back then that it might be a tweet. It might be something that would come out, and it would really rattle the markets because it was just thinking about doing something or throwing it out there, if you will, that would actually cause some of that volatility. I think this administration is likely to be a bit more methodical about it. That doesn't mean that they're not shaking things up. I think we've seen from from some of the cabinet appointments and some of
Right.
the people associated with it. We're not talking about establishment people running a lot of the show here. So I think there's certainly some volatility that's associated with that. I think the world looks a little bit different now than it looked previously. And so I think as we start to think about sectors, I think you want to think about these areas, again, that are associated with deregulation. So that's financials. Financials were really big laggards during the last administration, with the exception of the last maybe 6 months or so. I think areas like small and mid-cap type companies should start to do well if we're on this pro-growth agenda with lower regulation. I think that benefits, the small and mid-cap space.
Yeah, a lot of people don't think about that. Lower regulation actually disproportionately helps small and medium-sized businesses. And the reason is that they can now, the burden of doing it inside of the guidelines is not as great. Large corporations, well, we'll figure out how to do it, and they can afford to pay that extra expense, right? Small companies can't, and therefore barriers to entry, so competition becomes greater. And so those that have the newest widget can actually go and grow.
Right.
That is interesting.
Yeah, I think I think again I think information technology might be a little bit different this time. I don't think it didn't perform as well out of the gate the last administration, but I think we're in this evolving AI transition, which I think is driving a lot of spending. It's certainly driving a lot of corporate spending, and there's a lot of dollars, if you will, chasing that area. And there might be some other sectors of the marketplace that begin to participate, and maybe it's it's undoubtedly likely to be the industrial area, but maybe even some areas like materials, maybe where maybe they didn't participate to the degree that they did last time. But what if we need to build more infrastructure here? I know one of them is defense, as an example, where we want to modernize and update our military capabilities. And again, these are things that happened last time. I always tell folks, you always want to stay balanced, because you never know how the global investment climate is going to change. And I think so keeping that balanced, I think, makes a lot of sense. But the areas that are winning right now, some of them have a lot of catching up to do, relative to what I would call the mega cap technology type names. And so
they just haven't participated.
Yeah, just I think what you want to look for is a broadening of performance, if you will, beyond just the names that have really been.
And that's really healthy for the overall health of the market.
Absolutely.
Hey, Mike, thanks.
Really appreciate it.
I think this was very, very valuable. A lot of things to keep in mind, a lot of things as we look forward. And to our listeners, if you have questions, feel free to reach out. We're here to help out. And Mike, thank you very much. And we will see you next week.
See you then.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., and investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC. An SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.